Hey everyone, Mark Hart here from MIP Capital Partners, as well as our CEO and founder, Matt Sinclair. Today we're going to talk about asset selection and portfolio composition. Our investment screening process, the specific houses we purchase, our understanding of the suburban markets in which we purchase houses, and the way we structure our portfolios of new construction homes are competitive advantages for MIP Capital Partners for the benefit of our investors. We're getting our pick of the best houses in the best suburbs from some of the best builders in the MSA. We're also purchasing at scale, and so our terms are favorable, and the portfolio is designed to nullify cash flow volatility to the benefit of investors.
I spent many years working with financial sponsors and large publicly traded companies to design and build out acquisition and investment funnels, primarily during my career in investment banking with JP Morgan. I took everything I learned and created a three-phased, rules-based investment screening process for MIP Capital Partners. This is a funnel system that is used to screen each and every new construction single-family home that we consider purchasing. The system is strictly adhered to and is uncompromising. The 36 houses in Build to Rent Fund III are the relatively small percentage of houses that survive the screening process. This is a top-down funnel system, with phase one of the funnel being a suburban market screen. So within an MSA, Memphis or otherwise, that's experiencing suburban growth, not every suburb will be appropriate for investment for various reasons. We want to ensure that the specific suburb is experiencing sustained population growth and is in reasonable commuting distance of a diversified employment base. The point regarding a diversified employment base is really important. The MSA must be of sufficient population size so that the loss of one employer or a downturn in a given industry won't have an outsized negative impact on the employment levels of the tenant base overall. In terms of employment sources, it's critical for rental properties to be an MSA with acyclical and consistent employment sources like government, healthcare, and higher education exposure. In Memphis, healthcare, education, and government account for about 30% of total jobs. And so you have a large segment of the population whose jobs are quite stable, and people who work in these sectors can be excellent tenants. Also, a relatively low proportion of the employment base in Memphis is discretionary expenditure driven. That's important because in the event of an economic downturn, discretionary spending is often the first to be reduced. So certain markets that have a high proportion of their economies exposed to discretionary spending, like certain coastal markets with tourism, or Las Vegas for example, often exhibit a high degree of cyclical volatility, partly due to the high proportion of discretionary expenditures that play important roles in those markets. And for our business model, we want the most stable employment conditions possible. We also want to be in suburban markets with favorable supply and demand imbalance situations. And this needs to be carefully studied submarket by submarket. There's some excellent MSAs with lots of growth prospects, highly favorable sector exposure, job and wage growth, but their supply levels are so high that absorption will be problematic. It's critical to be in a market with a degree of supply inelasticity. School ratings are also something we pay a lot of attention to. As we'll discuss later in this webinar, school quality is something that the large single-family funds focus on and build their businesses around. Not every renter household will have children, but school quality matters because it is a proxy for and tends to be correlated with so many additional attributes about a submarket. Phase two of the screen constitutes preliminary underwriting. So of critical importance is an evaluation of a specific home builder. A given home builder needs to be a sufficient scale to be efficient, but at the same time, past a certain point, it becomes challenging for a builder to maintain excellent quality standards if the volume is too high. It's important that a builder have a long track record within a given market, and as much as anything, the builder must demonstrate excellent craftsmanship and quality of construction. So this is really important because without high quality craftsmanship and construction, the NOI margins will start to degrade considerably over time. It's also critical for houses to be well designed. Better designed houses resonate much more effectively with tenants, and that's demonstrated with better lease-up velocities for more favorable designed homes. I have an architect evaluate everything I personally or we at MIP Capital Partners consider purchasing. Architects can offer a high-quality professional perspective that is independent and objective. I feel that architects, frankly, are underutilized in the industry overall. So after going through these various steps, I create a full pro forma net operating income margin build for each property. So this begins with the derivation of projected rents for each property, and each operating expense line item is evaluated, including property taxes and insurance. And again, critically, this has to be done per property. It's my perspective that each house should be evaluated as if it were a separate standalone business, so it can be evaluated on its own merits. The overall business plan and estimated hold period is established, and a sales comparables analysis is performed for each house. This is really important for negotiating purposes with builders. The third phase is the detailed financial analysis. So I've established a set of 7 quantitative tests that I call our crystal clear criteria. It's really important to evaluate an investment through multiple analytical methods, as any one single metric, if taken in isolation, could lead to poor decisions. So we've developed a very rigorous technical process to ensure that we are properly considering many different aspects of the investment and using a thorough process of triangulation to ensure that we're not missing anything. The first 3 of these tests are applied to each house and to the portfolio overall. So firstly, we want to ensure that our realized purchase price, which is the price we pay once we account for the purchase discount, is below the intrinsic value. The intrinsic value is based on a discounted cash flow analysis. It is an estimation of the present value of cash flows to be received in the future, and this is theoretically what an asset is really worth. It's only rational to buy an asset or a pool of assets if the price we are paying is below the intrinsic value. The second test is that a realized purchase price must be below the replacement cost. And here we're defining the replacement cost as hard costs plus soft costs, plus the cost of a vacant developed lot, plus the builder markup. With the builder markup being estimated as the markup required by the builder as compensation for the risk and opportunity cost of developing the house at the margin. Replacement cost is a critical economic concept. If a comparable new construction house could feasibly be built for a lower total cost on a per square foot basis in a comparable location than what it would cost to buy the subject house being evaluated, then replacement cost would be lower than the cost to purchase a subject house. As an investor, we would logically pass on the opportunity. Because if the replacement cost is lower than the cost to purchase the house, then as the owner of the house, we would face supply risk because comparable houses could be delivered to market at a price that is potentially below the price we paid to purchase the house. So we always really want to work to make sure that we understand what replacement cost is. And again, we work in conjunction with our builder partners and our affiliated builder to really dig into the backup data to get granular about just exactly how this should be calculated. But we really do the work to make sure that we understand the replacement cost for a given house and make sure that we're buying at a discounted price below the replacement cost. So the logical question is, well, why would builders voluntarily sell you a house for this discounted price below replacement cost? And one of the ways we can achieve this is by buying in sufficient quantity from builders and being known by the builders as being very trustworthy and reliable purchaser with a very high degree of certainty for closing, such that the markup and margin that the builder requires to sell to us is lower versus the markup that the builder would require from the average purchaser. So that's how we negotiate deals with very reputable builders for the purchase of high quality new construction homes at realized prices below replacement cost. This is not something that would be available to any one single purchaser, myself included. So next, we consider the unlevered yield on cost, which is the net operating income at stabilization divided by the total cost of the investment. So very important to appreciate that this metric is on an unlevered basis, meaning that impacts of using debt to make the purchase are not considered. We want to make sure that our investment makes sense on its merits before the impacts of leverage are considered. So in the prior cycle, a lot of investors made the mistake of not accounting for the fact that a lot of the projected returns were attributable to leverage and not necessarily business fundamentals. We don't want to make that mistake, and the smart money has really turned to measures like unlevered yield on cost to make sure that the underlying fundamentals are sound. If an investment only works because of the impacts of leverage, then the event of adverse conditions, the leverage can really work against an investor. So we want to ensure that the unlevered fundamentals of the investment make sense, and only then do we layer in the impacts of leverage. So the unlevered yield on cost is a really useful metric, but it requires an assessment of the risk of the investment to properly interpret. So a project that involves renovation risk, let alone development risk, would have a substantially higher hurdle rate on which its unlevered yield on cost would be assessed. This metric also doesn't directly account for the time value of money. So the time that is required to reach stabilized NOI should be considered. In our case, for funds 1, 2, and 3, for example, our stabilized NOI is achieved at the time we lease up the properties because we don't close on the purchase of assets until certificate of occupancy is achieved. So we don't have to endure a construction phase to reach stabilized NOI. In contrast, a large renovation project can take several months and sometimes more than a year to reach stabilized NOI. And if that's the case, the unlevered yield on cost would need to be very high to account for the significant time delay before stabilized NOI is achieved, during which time significant cost would be incurred without offsetting income. The fourth evaluation method is also unlevered. This is an assessment of the unlevered internal rate of return on the portfolio of houses compared to a specifically derived opportunity cost of capital, where the opportunity cost of capital is imputed using a base risk-free rate and then a risk premium that we can basically derive from market-based credit spreads that we can observe. We want to make sure that our unlevered internal rate of return is sufficient to compensate us for the risk of the investment before we account for leverage. Again, an assessment of business fundamentals irrespective of using debt. The final three tests account for the leverage in the portfolio. The fifth test is to ensure that we are covering our lender stipulated debt service at our given loan to value ratio. We want to perform this analysis at this stage because we want to make sure that we're properly sizing the amount of debt we take on. It's very common, especially in the real estate industry, for investors to maximize the amount of leverage because the cost of debt is generally lower than the cost of equity. So taking on more debt reduces the amount of equity required in the deal, so the returns on the equity and the IRR to equity investors increase. However, as the proportion of debt increases, the cost of the debt can increase as well. So although the IRR may be increasing as the proportion of debt increases, the implied cost of equity, theoretically, and thus the required return on equity and the required lever IRR, will actually be higher as the amount of debt is higher because the rate on the debt will go up as the portion of debt goes up because the lender needs to be compensated for lending incrementally risky debt. And as that proportion of debt leverage in the system goes up, the levered IRR obviously will go up. But the risk to the equity can go up to the extent that the incremental increase in levered IRR from taking on more debt might not be worth the incremental risk. So many prudent investors will solve for a optimal loan-to-value ratio, and that optimal loan-to-value ratio may be lower than the maximum loan-to-value ratio that the lender will permit. We are basis-oriented value investors, and we're looking to make our money when we buy. That is our philosophy and something we strictly adhere to. So the sixth metric is to ensure that the forced equity accretion to equity holders, our limited partners, at the time we close permanent financing relative to their initial equity investment basis is sufficient to justify the investment. And we make this assessment using the third-party appraisals that are required for lending purposes. And we also assess this on an intrinsic value basis. And finally, we assess the IRR and multiple invested capital on a levered basis and assess the results in the context of the required return for the risk profile of the investment. Ideally, we're aiming to be generating a levered IRR to investors in excess of the threshold. And this is where a highly specialized and focused investment manager with a competitive advantage in specific suburban markets can really add value and deliver a unique value proposition to investors from a risk-return perspective. And now that we've run the 7 crystal clear criteria tests, there's another really important step that's often, if not usually, overlooked, but practically is critical. An investment could look really good from a levered IRR perspective in its base case, but actually not perform well in a downside scenario at all. And we want to ensure that any investment we make will be able to weather adversity, like a recessionary scenario, for example. This is particularly important in a business with high fixed costs and an environment of elevated interest rates. A downside scenario could present liquidity challenges and is essential to be building and using really robust financial models that are purposely designed from the outset to be very flexible and accommodate scenario analysis so that we can run these cases and drive an accurate perspective of what things could look like in a recessionary scenario. For example, we're not able to raise rents for a few years, or a scenario where vacancy is elevated for a period of time, or a scenario where our NOI margins are low for a period of time because operating costs unexpectedly increase. Like, for example, in some years, increase in insurance is above forecast. We want to make sure that we're able to absorb an unexpected shock like that. We need to ensure that our investment can weather the storm, and we need to ensure that in a downside case, we can make our distribution payments and debt service payments in each and every month of the forecast period. And if we can't, then we shouldn't be making the investment in the first place.
For BTR Fund III, the culmination of our rigorous investment screening process is a portfolio comprised of 36 individually selected new construction houses built by best-in-class local homebuilders, diversified across 3 submarkets and 8 developments. Each home is of sufficient quality to be a primary homeowner-occupied home. The homes are located in safe suburban communities with access to diversified employment bases and various amenities. We will have been able to attract very high-quality tenants, and for Tranche 1 of BTR Fund III, which we close on September 30th, from a leasing perspective, we are outperforming our forecast. The floor plans of these houses are well designed, and the finishes are stylish and upgraded. A major benefit of working with very strong home builders who take a lot of pride in their craftsmanship is that these homes will stand the test of time and be very efficient from an operating cost perspective through our forecast period. Here are the details of the 36 houses. The total list price is $15.5 million, but we secured a 10.2% purchase discount, so our discounted purchase price is $13.9 million. The average purchase price is about $430,000, and these are all 4 or 5 bedroom, 2.5 to 4 bath houses with an average square foot of 2,400. The average rent will be about $2,640, with total monthly rent expected to be over $95,000. Critically, we have a lot of experience with owning and managing comparable new construction houses in these select suburban markets. And one of the key characteristics of these houses is their excellent NOI margin profile. We estimate that our total portfolio NOI margin for BTR Fund III will be approximately 71.7%, and so a high proportion of that monthly rent is converted directly into NOI. In an environment of elevated interest rates, elevated NOI margins are a very attractive attribute to be able to cover debt service with room left to cash flow.
MIP Capital Partners has been very intentional with the types of houses that we acquire on behalf of our investors. We're focused on Class A new construction houses in safe and growing suburban markets with strong schools. We're looking to attract tenants that are in a stage in life where stability is very important. The chart on the left shows the average monthly rent on the x-axis and the number of homes owned on the y-axis. And as you can see, it's clear that the largest and most scaled players in the industry are focused on the higher end of the rent spectrum. These tend to be newer homes in growing suburban markets. These homes attract strong creditworthy tenants who have an ownership mentality, and generally will stay for longer durations of tenant occupancy. Something that's very important to note is that the single-family rental industry remains unconsolidated and is its early stages when compared to the other real estate asset classes in terms of the level of institutional ownership. So in many ways, the single-family industry is where the multifamily industry was 30 years ago. Most single-family rental properties in the United States are owned by landlords who own 10 or fewer single-family rental properties, and the overall level of ownership by large institutional landlords for single family is actually a fairly small percentage, and this presents a significant opportunity. On the right side of the page, you can see a chart depicting school quality for each of the largest single family players in America. Clearly, it's something that the most informed participants in the market are very focused on, to the extent that their acquisition strategies are using school quality, school ratings by grade schools as a major governing metric. We're very focused on this, and BTR Fund III is an average school grade of 5, according to Grade Schools, which puts us right in the buy zone for the largest players, and the interquartile range of school quality for the BTR Fund III actually overlaps with Progress Residential, First Key, and Amherst, all of which are landlords in the specific suburban markets in which these homes are located. And this is by design. We have several potential exit strategies, but a sale to one of these major single-family owners could present a very favorable outcome for our investors because these excellent businesses have a high ability to pay due to their low costs of capital.
All right. So if anyone is interested and would like to learn more or would like to have a one-on-one consultation with myself or Matt, please follow the links below this video or please visit our website at mipcapitalpartners.com. We are actively raising equity from investors, although they need to be accredited investors. And if anyone is interested, please let us know. Thanks.